Hello, in this video we'll continue with our gross income problem set. This is problem number 11. So here Melon is a tax accountant working at an accounting firm. And Melon is going to receive and have some various items that we need to consider whether they're considered gross income. So remember, whenever we have gross income, we always need to ask really 5 questions. First, what amount of gross income, if any, does the taxpayer have? Second, what amount of deduction or credit, if any, does the taxpayer have? Third, who has to record the income? When does it have to be recorded? And then finally, the last one is the character of the item. So we're focusing on gross income. So really, we're looking at the what, when, and who questions. What amount of gross income, if any? When does it have to be recorded? And who? Now, we're dealing specifically here with Melon, so that's the who. There's no other parties here. It's the accounting firm, but these are all going to be inflows or potential inflows we're addressing. We're not addressing the accounting firm that's paying them, that's outflowing them out. We're dealing with gross income. The when, all of these happen within the same year, so that's going to be not an issue. That's, the when issue becomes if you have multiple years. And the what, that's really what we're focusing on. So let's go ahead and read the first item, and then we'll talk more about the general idea of gross income, and then we'll analyze. So Melon receives a new car each year from her employer to drive to client sites. So this is an employer-provided car. And Melon is the main idea here is that Melon uses this car to drive to client sites, prepares tax returns, do tax consulting, whatever is needed. Now the fair rental value of the car, so if Melon actually went and leased out this car, would be $15,000 for the year. There's no restrictions placed on Melon's use of this car. All right, so we're trying to determine if this car, the use of the car, which is the fair rental value of $15,000, should that be included in gross income? That's the what question. If you remember, when we define gross income in the tax law, we first start with Section 61. Section 61 says gross income is income from whatever source derived. Extremely broad definition. Then we go to our Glenshaw-Glass definition to get a more narrow definition of gross income to help us, and there must be a undeniable accession to wealth. That's the first item, which means our net worth has increased, and net worth is viewed as assets minus liabilities. There must be a realization event, so it must be realized or realization. And finally, the third item is that there must be complete dominion and control, D&C, which means there's no strings attached to the item. So here, at the beginning of the year, Melon does not have this car. At the end of the year, Melon does have this car. So Melon has a car, or the use of the car, which is an asset. That is an economic benefit. So yes, assets have gone up for the use of the car. Melon doesn't own the car, but Melon has the use, and that is an economic benefit. Next is realization. Well, Melon is getting that as a result of performing services. This is a perk of being part of this job. It's used in the job, but it's also used for personal use. You could use this on the weekends, drive various places. Now, there might be a limit on the number of miles and whatnot, but still there is personal use. No restrictions are placed on the use of the car. So the realization, there are services that allow that, and the services create realization. Dominion and control. So this is really the most important part here. Because there's no restrictions, there's no strings attached. So therefore, there is dominion and control. And that means that this item, this $15,000, that's the value of the use of the car, is gross income to Melon. This is gross income to Melon. And there's no exclusions that provide this not. You can't get any of the fringe benefits. There's nothing out there for that. I'm just letting you know. There's later videos that'll talk about exclusions. But specifically, there's no exclusions out there. This is gross income under the definition, and there's no exclusions to take it out. So it will be gross income to Melon. It will be included. That's the key word, is included in gross income. Now, I want to note something. What if I told you that the restrictions on this car are that Melon can only use it to drive to clients, and Melon is not allowed to use it for personal service? Well, again, it would still be, there would be an increase in net worth because of the use of the car, because Melon wouldn't have to use his or her own car. The realization from services, but dominion control would fail because there would be strings attached. meaning that Melon could not just simply do it whatever she sees fit. it's only used for the client and not for Mellon's personal use. So this is why a lot of employees or independent contractors that get cars from their employer or their company, they don't have to include it because there are strings attached. Whether it's a mileage limitation, they can't use it for personal services, various things. But that's why a lot, you might be thinking, well, if no one has to include this, I know someone, they don't have to include it. That's probably because they have a restriction on the use of their car. So this is in fact included. So $15,000 is included in Mellon's gross income. Not the value of the car, the value of the actual rental, the lease. All right, so let's go to the next item. Mellon drives another car that she owns. Now the fair rental value is $10,000. Now the issue here becomes, okay, well, we saw here that the employer provided the car. Well, here Mellon buys a car with Mellon's own money, and really Mellon drives it around for personal use. And the fair rental value is $10,000. Should that also be included? Well, this one actually comes down more to, from previous videos, we talked about economic versus financial accounting income. And remember that gross income for tax purposes falls somewhere in between. Economic income includes what we call presumptive. And remember that gross income for tax purposes starts with an economic definition under the Haig-Simons definition of income, which is an economic definition of income. Presumptive income is when you as a taxpayer use your own property that you own, or you do your own services. Use property you own, or you do your own services. Now, when you have these things, so some examples of using your property, if you buy a house and you use that house, you live in it, that's an example of using your own property. You buy a car, you're using the car, and that's what Mellon's doing here, in any way you want to do. Doing your own services, what if you mow your own grass or you paint your own house? You would have to pay someone those items, and economically, they would, or if you did it for someone else, you would have income if you were doing it. If you were mowing grass for your neighbor, right, your neighbor next door, and you got $30, that would be income. But if you did it for yourself, would that be income? Economically, yes, it would, and it would be the same $30 of income. Basically, economics makes no distinction between you and your neighbor in that case of the mowing the grass situation. Again, the neighbor, you would have to record that income under financial, economic, tax, but you as doing your own mowing of grass, financial, we know that's not the case. Economic, yes, you have to record that. That's called presumptive income. Tax says no presumptive income. No presumptive income for tax purposes. And the reason for this is because of administrative concern. Think about all of the things that you do. Cooking, cleaning, all these things that if you did this for someone else, you would get paid for services and you'd have to record as income. This would be an administrative nightmare if you had to record all of this for the year, not only for you as a taxpayer, but also for the IRS. And also, how do we value these things? So not only keeping track, record keeping, but also valuation. So that means that this $10,000 of fair rental value of Mellon's own car is not included as gross income. It's actually not gross income at all. It doesn't even meet the Glenshaw Glass definition. So it's not included in gross income. It's not gross income. It's not even excluded. It's just not gross income. It's not included as gross income. Finally, the next one is Mellon fills out her own tax return because remember, Mellon is a tax accountant. Based on her normal hourly billable rate at the employer, the accounting firm, this service will be worth $1,000. So if Mellon was doing this service for one of the accounting firm's clients, and then Mellon got paid, that's obviously going to be gross income. However, Mellon's doing for his or herself. So that means it's doing your own services, which we just said is not gross income because it's considered presumptive income. It's not included to Mellon as gross income. And the reason is because it's presumptive income. Presumptive income, again, from an economic standpoint, is income, but it's not income for you under the tax law when you have presumptive income. So I hope this helps. The takeaway here is that Mellon has $15,000 of gross income total from these 3 transactions, and that's because this case, we saw there was no restrictions, but the other 2 situations are presumptive income. Presumptive income is when you use your own property or do your own services, which under the tax law is not income.